welcome to the next panel, which is about backing African ventures, understanding LP appetite in African venture capital. Very excited to be here. My name's Juliette Munro. I'm the Director of Early Stage Finance at FSD Africa. We're a specialised financial sector development agency and catalytic investor that really is focusing on strengthening Africa's financial systems so that it can mobilise capital in large quantities and help to allocate it into the right places to promote long-term sustainable growth. And we use both grant and investment capital to do that, both backing African venture funds and also co-creating large-scale investment structures and really working across the financing continuum in doing that. And we do that in partnership with many of you in the room and also on this panel. And we're very passionate about African venture capital as well. Really just to set the scene before going into the panel questions, I mean, if you've looked at the latest AVCA data, you'll see that the story over the last year has really been one of market stabilization. And there has been some positive trends around increases in venture debt, increases in climate investing, more localized exits, and so on. But the picture is really about resilience as opposed to material market growth. There's also been some really interesting capital reconfiguration happening. Some declines in DFI commitments over the last year relative to other investors, at the same time as an uptick in corporate investing and from pension funds and insurance industries. And so with the backdrop of these kinds of shifts, we really need to look at what's happening in the market. I mean, global capital, in spite of those shifts, it continues to dominate. There are also increasing concerns that some of the global capital that's there is starting to go up market more, which is creating potential erosion of early stage investment. And if that isn't addressed now, that really threatens to undermine the large scale future pipeline. So I'm going to start with you, Natalie. And Proparco, you've been investing in the venture capital space for probably close to a decade. And in that time, you've invested in over 200 startups, both directly and through funds, including recently in Ventures Platform, in Lofty Inc. Capital, and in MTech. And you want to do more. You've got this backdrop of increasing appetite. We've got this backdrop of a declining DFI commitment, which actually declined from 45% between 2021 and 2024 to 27% last year. So it's quite a significant decline. What are you seeing as the current motivations that's shaping LP allocation decisions? And in particular, perhaps you can speak a little bit from the perspective of Proparco and your own future mandate.
So I'm part of the VC team at Proparco, based in Paris. And I would say first that 50% of the investment in the VC space, in the VC ecosystem in Africa has come in the past, at least in the past decade, mostly from the DFIs, like 50%. So at least I think it's very important to give them the credit that they really built, and they have been very active in building that ecosystem. Now, that being said, I think the role of the DFI is definitely to show that you can show returns and you can attract private capital. So obviously that's the whole perspective, that at some point we will give the baton, to more public banks and private investors. That being said, just to give you a picture of Proparco, so we have been investing in Africa in VC for the last decades. We started with the first VC fund, Novastar, in 2014, so a long time ago. And obviously, since then, we have invested in 30 VC funds, roughly $200 million, and in 45 startups, roughly $45 million. So we do both indirect and direct investments. And obviously, the figures speak by themselves. So we have been quoted the sixth most important investor in the VC ecosystem for the last 2 years by the Partech report. And we are obviously very proud of that. But more than the figures, what is very important for us is that we really follow where the market needs are. So 3 years ago, there was a very big gap in the pre-seed. So at that moment, we had our Digital Africa subsidiary that really started to invest in pre-seed with small tickets, 10K, 200K tickets, really to build that foundations, because to reach out to the moment we are in the Series A opportunities, we really need the pre-seed investments. So it's a very important part of our strategy to have our subsidiary Digital Africa. Then 2 years ago, we see that there was really a need in seed. So we started to invest through a FSD instrument to really finance the $1 million tickets and the 500K tickets to really promote and prepare the startups to be ready for the Series A stage. Now, because we have been an investor for the last 10 years, it's very important for us that we start seeing exits. That's some signals which are really key. If you see in Africa right now, it's only 20 companies that have been able in the past 10 years to reach out, strong M&A, more than $15 million. And obviously, we want to see more. So I would say for the next 12 months, we really want to focus in investing in growth PE funds, really preparing the Series B, Series C. That's very important. And we will also invest more in direct co-investments, doing co-investment with our investment partners. And obviously, our Digital Africa team will continue working on the pre-seed, seed environment. So that's where we are going in terms of direction.
No, great, but keeping that diversity of different types of responses to the market needs, I think. Kento, I want to bring you in and just sort of reflect in terms of global capital reconfiguration. We've seen a surge in Japanese institutions participating in the market, which is really interesting. I think Japan is now the 5th largest unique investor in terms of commitments at the moment. And JICA itself, I think more recently, you've become an investor in the VC market, including in Innovator Ventures. So we've got some comparative there. What's driving Japan's growing interest in the VC market on the continent? And the ecosystem space more generally, and what are the specific outcomes that you're looking for as JICA, as a global development agency?
Thank you very much. So JICA, so before I answer the question, let me walk you through a little bit of what JICA do. So for those who might not have heard of the JICA, we've been, we as an offshore development assistance agency, we have a long history of working in this continent. For example, in Kenya, we started operation in back 1960s. So we have a long history and also grounded history and also expertise and then partnership with the government. So I think that's the very important facts that probably differentiate us from the other most of the DFIs. With this, we do and has been actively investing in African continent, including VC ecosystem. So from that experience, what we're seeing, I can talk about is the very big dynamics. In terms of the investments in Africa, that's a shift from the speculative boom to the more grounded strategic phase. So African venture investment is increasingly being driven not by short-term psychodynamics, but rather I think it's by the clear strategic intent. And Japanese institutions, companies are no exception to this. So for many corporates, African startups now viewed primarily as a strategic investments domain that supports future market entry and technology collaboration, as well as supply chain development. So this is very good partnership for the most Japanese companies seeing. So as a result, corporate investors tend to place less emphasis on maximize short-term IRR and instead prioritize like the future market business synergies, and strategic alignment. So from this perspective, we also share this strong dynamics. So one of the key missions we have is definitely mobilize more capital, include Japanese. We're trying to align with this dynamics, mixing our strengths we have, that is, public and private partnership, while building ecosystem together with the governments and policymakers and the investors and everyone we here today.
No, great. That's really interesting. So there's a sort of role in the global agency in enabling and unlocking that capital, and perhaps linking that to the issue about local capital. I mean, through initiatives like your Ninja initiative, for example, with Ninja, you're partnering with the Nigeria Sovereign Investment Authority to help unlock that local capital. Maybe you could say a little bit more about the role of your agency, your capital, in helping to unlock that further.
Yeah, thank you very much. Yeah. So the Ninja and our cooperation with the Nigerian government is one of the examples. We built upon our collaboration and partnership with the government, while our strategic attempts to collaborate more with the private sector, definitely. But I think there's something maybe most of us might sometimes forget. That is that there's a huge gap, between the private sector development and infrastructure. Infrastructure includes a lot of things, all soft and hard infrastructure. So our key, strategic way to build a better business environment is bridge the gap between private and public. Maybe some of you might try to stay away from the government because there's a risk, policy risk. There might be some governance issues, but I think with the DFIs, as a DFIs, we definitely need more to do infrastructure. So that's why we always been investing using sovereign loans to build from the scratch. And then for the most of the startups, I think that's also very key to address. There might be some lack of the essential fundamental infrastructure they might start building on their own. I think so. I think this is a very good example. We should always be aware of, how many stakeholders and on what area and what each of us need to work on.
Yeah, well, and now we can turn to you, Abishkar, from a foundation perspective, because obviously at Visa Foundation, I think you've invested close to $200 million globally in impact investing, which in Africa VC terms are in investing in things like Arua, which we've co-invested in through our Nyala facility as FSD Africa with you, Tide Africa and SeedStars. So you're a catalytic investor as well. And your portfolio, I think, has demonstrated, I think Arua is a very good example of this, of an ability to mobilize local capital. What structural barriers do you think must be addressed in order to really unlock significantly more? And what does your role play as a catalytic investor?
Sure. Thank you for the question, and good morning, good afternoon, everybody. Great to be here. And before I dive into the answer, just for a little bit of context, I'm representing Visa Foundation. I oversee the investment portfolio for the foundation, as mentioned, and we are a global allocator. And linking that, our global allocation role to the topic at hand, the key thing that we see in terms of a constraint, and it's not something that's necessarily just here in Africa, right? I think it is a global issue, and the issue is the LPGP model is a very unique and specialized one, right? Like by nature, there is a separation of role between LP and GP. As an LP, you're doing a lot of upfront diligence, vetting of the team, reference checks, vetting investment strategy. And once you commit, you're sort of like delegating the day-to-day, the investment portfolio construction, structuring, management, all of that to the GP as it should be, and hence the LP relationship. And at that point, the LP's role is to be involved, but more in like an oversight role through LPAC advisory committee, impact advisory committee, things like that. And that separation is something that I think each institution sort of like finds a little bit of challenge with getting used to, and it applies even to global investors. But I think for local investors, local regional institutional LPs, whether it be pension funds or other types of regional LPs, it can be challenging because I think they, even more than global LPs, face slightly acute, different type of political, regulatory, reputational, market dynamics type of constraints and challenges when it comes to the type of strategy that the GP is executing, right? Whether it be portfolio construction, pacing, those types of things. And in the case of Arua, to your example, I think like one of the things that we've been really happy to see and what Arua has been able to do is facilitate local and regional LPs such as Bank of Industry, some pension funds, insurance funds to come in. And they've done a really thoughtful and intentional structure of where there is opportunities for these local LPs to be present in the advisory committee, even though their ticket sizes and check sizes may be smaller than the institutional LPs that are coming from the global and foreign and international side. So I think that's both a structural constraint, but also an opportunity to kind of like shape that together. And as I said, the mobilization of local capital into VC ecosystem, I think it's a little bit of a global challenge. I mean, like even if you compare relatively deeper capital markets, EM capital markets such as Mexico, maybe India to some extent, there are some pockets where local institutional whether development banks or insurance companies are investing into VC, but it's fairly nascent, I would say. I mean, I don't think, and we should have the impression that those markets are much more ahead of what's happening here in the continent. And in many ways, those types of ecosystems, the pension systems there, the insurance systems there, they were developed a decade, 2 decades ago, and their mandate was to really invest in safe government bonds and liquid bonds and treasury assets and listed equities, right? Like whereas and the local VC ecosystem there also kind of like didn't develop at the same time as those institutional pools of capital. Whereas here, arguably, kind of like drawing a little bit from the Arua example, I think there might be opportunity to sort of like co-build both the local capital market ecosystem as well as the local VC ecosystem so that you are facilitating local LPs to participate in that structure, because ultimately, I mean, like the previous panels have also talked about this, VC is a specialized asset class, right? You are locked up for a long period of time. It's illiquid by design. You're taking a lot of risk. Exits are still unproven, and I think that's a little bit of a global story as well. So that's what we see from our perspective.
Yeah, no, well, that's fascinating, and it's quite a nice segue actually to you, Eva. You're so far away, by the way. I hope you can hear me.
Yes, we can.
But really now shifting perspectives a bit more to focus more on local investors. And just as I said at the beginning, the sort of increase in corporate investment that is starting to happen, but also the shift in strategic investment strategies from pension funds and other institutional investors. So maybe Eva, you can speak about Britam. I mean, you're providing insurance and financial solutions to millions of people across the continent, or across, I think, 7 countries that you're operating in Eastern and Western. Eastern and Southern Africa.
Yes.
Eastern and Southern Africa, yeah. And so you're already very heavily invested in the continent, but now increasingly you're starting to invest in the VC space. through initiatives such as Better Lab. As I said at the beginning, corporate investors have become the largest group of investors as of the data from last year, representing 41% of commitments. So it's quite a significant jump. What do you think is driving that shift amongst corporate investors? And what has your experience been specifically with the Better Lab initiative that has sort of helped you learn about VC as a tool for growth, for inclusive growth, for scaling and so on?
Thank you, Juliet, and good afternoon, everyone. Yes, like you said, Britam is indeed in 7 African countries, in East and Southern Africa, and we're still expanding into Africa. We do believe in expanding and ensuring that there's financial inclusion across the globe. From our perspective, we really must work with the startup ecosystem community because we are a very highly innovative corporate, and we believe that disruptions in this space will not come from the traditional players. So we do not look at traditional insurance players as our competitors. We do look at ourselves and how we can disrupt that. Having said that, then we have made deliberate decisions to bring this ecosystem, these startups into our business. Instead of seeing them as competitors, we do see them as value addition. So we are investing in startups. And what we are doing here is providing them more than capital. We provide them scale. We provide them what we call customer number one. And you will realize, as from our experience, that this ecosystem, yes, all of us are here talking about capital, it's very important. But then if they don't have access to customers, they don't have access to distribution channels, then how are they going to experiment these solutions they have? How are they going to scale up? And that is where the role of corporates come in. And we therefore are supporting these startups to de-risk the first 2-3 years of operation. Our success has been quite phenomenal. Some of the startups we've invested in. As Britam, we have 5 million customers across Africa, and we also run a business which is the Britam microinsurance business that speaks to the youth and the emerging customers. As you all know, in Africa, the youth market is ballooning. This is the only continent that you have a lot of youth. Therefore, we believe even at 5 million customers, that number can grow to more than 30 million in the next 5 years. The only way to do this is to really catalyze the ecosystem. It's to expand our reach as corporates and support these ecosystems. And definitely we can't do it alone. We work a lot with partners. We work a lot with other like-minded partners in the ecosystem, either for capital providing or even to just give them certain support that they require.
Yeah, no, good. Well, and I think, despite the promising trends that we're seeing, there's an acute underexposure still to African corporates in the VC market. And so I think in spite of the fact that actually there's quite a lot of alignment around long-term horizons, appetite around the need for diversification and that kind of thing. So I think there's a lot of work that we need to do. And I think just linking back to what Abhishekar was saying about structural constraints, I mean, what do you see specifically as the structural constraints that we need to address for the insurance industry? And what could the role of some of the catalytic capital that we've got on the panel and in the audience, what do you think that could do to help with unlocking that insurance capital?
Yeah, thank you. Even as we do this, we do face significant challenges. And the first one is the fact that, yes, we do have patient capital, which really helps us wait out on these VCs. But you know that as an insurance company, there's really a limited amount of investments we can put in this space because it's seen to be very high risk. So if I'm talking to my board about, am I going to put $1 million in a government bond, or am I going to throw it into the VC? Definitely from the nuances of regulations, from even a return on investment, it becomes a big risk. And these conversations need to be had across so that we can begin to look at this space differently. So that's one of the biggest sort of challenge that we face. The other one we face definitely, like I've said, is the fact that our pockets are not, yes, we do have capital, but it's not sufficient. So we do need support, and especially on de-risking our investment. So this is where the role of blended finance comes in. We still need support from the DFIs to sort of bring that first loss advantage, because we are very risk averse. We do not have the awareness. How then can we get support, or how can we work together to ensure that even as we get the blended finance, there's also a lot of capacity building, a lot of conversations like this and these topics here in Africa to just enlighten both the government, the regulators, corporates like us, so that we can all join this, because if only one corporate is trying to do it, or a few of us, then it's not enough. So we need to have conversations where we are all partnering together. So I do believe the secret sauce is in the collaboration, it's in the blended capital mobilization, and it's also in the regulators allowing some room for experimentation, allowing for some room in the African continent for corporates to feel safe as they support the ecosystem.
Great, thank you, Eva. And maybe Alex, I'm going to just turn to you last but not least, just reflecting from the pension industry on some of these issues and what you're trying to do. I mean, I think we're seeing as a community that there's an awakening within the pension industry in terms of interest in alternative assets, including VC. And I think at NSSF Uganda, you are starting to make moves. And you're looking at investing, basically building on some of the experience that you've gained from your High Innovator initiative in the market. So I'd just love you to share a little bit about your experience and how that's making you think about the facility that you're looking to set up within the next year.
Yeah, thank you very much, Juliet. So my name is Alex Rumanyika. I head strategy at the National Social Security Fund, but that title is a bit of a misnomer. It sounds very fancy, but most of the time my work is really convincing the management to do things that are really, let me call them crazy. Pension business is very conservative, and so when you want to get into new opportunities, which are in line with your growth trajectory, there's a lot of pushback. And most of the pushback is driven by fear. So what can go wrong? So I traveled deliberately here with our chief risk officer. He's somewhere there. He's watching over me, making sure I say the right things. But one of the reasons we do that is to make sure that we start to understand these new spaces in a collaborative manner. And so one of the things that I'm privileged to have as a strategy person is defining why we need to go somewhere. And we often do it through storytelling. One of the stories that, there are about 2 stories we like to tell. The first one is 10 years ago, when we look at the money that was coming into the fund and what was going out in terms of benefits, the percentage of what we collected versus what was going out is about, or rather, percentage of what was going out compared to what was coming in was about 77%. 10 years later, it's about 27%. And what does this tell you? It tells you something about the African economy and how the economy is structured. The formal jobs are very few, and pension funds essentially depend on these formal jobs. Now, if you have a situation, the current trend where you're collecting at a decreasing rate, more money is coming out, because a lot of the people who are members, quite a few of them are retiring, but they make up a very small portion of the new jobs coming in. So the key question we asked ourselves is, how do you create new members of NSSF in an economy that's not creating enough formal jobs? And that is really our why of getting into the startup space. The reality is, if we don't get into this space, it is going to be an existential threat for NSSF and many pension funds. And I think that's very important to acknowledge. So that was the first thing, understanding the why. The other imperative is when you look at our asset allocation today, and many pension funds have the same problem, I think even in Britam, we're 80% exposed to government bonds. Now, if you know what happened in Ghana then and you're a risk person, I think you'd rather spread your bets a bit more, but in a structured manner, than having all your bets in this one place that can really pull you down. And so our why is clear. We have to diversify our assets. And the other why we have to get into SME space is because that is where the jobs are. So the key question now for us is how do we get into that space in a manner where the people we call trustees who hold fiduciary responsibility are comfortable. Really, that's what we are trying to address. And we've chosen to do it in a bit of an unconventional way, rather than get a consultant and sit down and say, how do we get into this space? What we've chosen to do is to look into these spaces, rooms like this, and see who in there can help us. And thankfully, FSD is all helping us. We've got them on board to support us with looking at the industry. We're really looking at people who understand this space to help us build a vehicle that can create an investment asset class out of SMEs. Perhaps one important thing I should add is that to get our first steps into this space with the High Innovator, we didn't do it as an investment. Rather, what we chose to do is to do it as a CSR. Because at that point, people didn't understand it. You're taking high risk with public money. So we collaborated with the MasterCard Foundation. They provided some soft capital, and we got into these the SME space, invested in 438 startups today. And on average, they have multiplied their revenue by about 3 times in the last 5 years, which means it works. We have got 3,000 new members as NSSF, which means it works, okay? And now we're having conversations about setting up a a vehicle to make this an asset class, which means that the interest it has garnered is actually working. So now what we're trying to do is really transform it into an investment vehicle for purposes of sustainability. And that's where we are so far in that journey. Hopefully, by next year, we will have this vehicle up and running. I think it's important to draw inspiration from West Africa. I think the Chigaba Fund of Funds is something we all need to look at and say it has worked somewhere else. This time, I think it's the pension fund that is trying to lead the conversation. I think that's the big difference.
Yeah, I think that's what's really exciting about that. And we look forward to working with you and drawing in other investors to help you with anchoring that facility. I'm conscious of time, and I'd love to open it up to the audience if anyone has any specific questions that they'd like to ask the panel. I think there's one over there. Yeah.
Thank you very much. My question is directed to Abishkar. So we know that, at least for African venture capital, I think venture capital generally, the risk, apart from the product and the market and the industry, there's operations and also governance, especially in some jurisdictions. So what do you look out for when investing? What do you look out for in those VC fund managers, and how they relate? Because as an LP, the oversight is limited to the LPAC, right? And there's a limit to what you can do. So what do you look out for in VC fund managers to respect to those risk operations and governance?
Great question. I think it is a little bit of a case-by-case analysis or consideration, right? But I think like one common thing that we look at across the board is Visa Foundation. It's a strong philosophy of mine as well. Ultimately, the risk is investment portfolio construction, right? Like, I mean, that is the main thing. And when we look at early stage funds, obviously some of that is borne out by how the team has come together. We look at track record, but we do look for advisory or investment committee roles that the fund and the fund manager are able to tap into for certain sectors, for certain type of investing, maybe structuring to complement what the organic team already has. And you mentioned LPAC, and then like some LPAC, there I think like a lot of us realize like LPACs have a fairly broad mandate, and some LPACs work better than others. But I think like in a good LPAC, the thing that we're always looking for is there's a clear demarcation of what is the GP's role and where does the advisory committee really step in, right? And for us, those things are related to really critical things like audits and valuation, and those things are something that we really focus and hone in on before we make a commitment. And as I said earlier in my opening remarks, that structural role of doing a lot of that upfront diligence, but then afterwards taking a little bit more of a backseat role is something that, in my experience, it's a little bit my personal or professional opinion. I think like every LP is on a journey in that regard, right? So I don't want to paint that as a local, regional, international versus domestic type of off and on topic. I think it's a role that is, again, as I said, very specialized, and everybody kind of like finds the right balance in that spectrum.
Thank you. Have we got time for one more question? Any other questions? Okay, well, I think just in wrap up, I just very, very briefly, because we've got 2 minutes left, can you just maybe specify what you think the single biggest priority is that needs to happen really, so that by AVCA 2027, we're seeing a doubling or more of the involvement of local capital in the African VC story? Maybe Natalie, you could start.
Yeah, on Proparco side, I guess we do expect the public banks to really come in. There is a wonderful signal. Venture platforms just closed, in November, $64 million close for a national early stage Nigerian fund, this VC fund. This was an amazing step. And for the first time, we could see the Bank of Industry coming in. And this is a wonderful signal because this is bringing the private investors. So that's really what we are expecting now.
Great. Kento?
Yes, thank you very much. I would say more conversation, more deep relationship between LP and DP, because we sometimes rely on the GP for mobilizing capital. Even in Japan, there's some very good fund managers to make the narratives that everyone believes. I think this kind of conversation and also mutual understanding will be key for unlocking capital.
Great, thank you. Abishka?
In the interest of not repeating some of the things I've already said, I think longer term, like in a year and year two, what ultimately this rests on is more liquidity, right? And more conversion of unrealized value into realized value, more exits. So I think, again, realistic, that's not going to be magically solved by 2027, but I think that's the key unlock, for sure.
Absolutely. Eva?
From a corporate perspective, like for example, for us in Britam, we are starting with our first fund, which is Beta Lab, and we intend to do more and also allocate more capital into the alternative investments. So we believe that partners who come in and step into the African continent to support some of these initiatives will help really prove that African investment can spur innovation and can spur success across the globe. So calling on partnerships with other partners.
Lovely. And Alex?
Yeah, I think we need to see more wholesale type vehicles supporting SMEs, fund of fund type vehicles, and pension funds investing more of their capital to these vehicles. I really believe that will stimulate more venture funds to grow, and especially in being diversified. That will also, and these should be local currency vehicles investing across the region. That will also stimulate the actual working of the Africa Continental Free Trade Agreement, because they'll start to work across the region.
Yeah, good. Well, thank you very much. If you'd like to join me in giving our panel a big round of applause for a good session.